ManpowerGroup just beat consensus expectations for Q2 2026.
They absolutely did.
I mean, you are looking at a top-line revenue print of $4.9 billion. That is an 8% increase as reported, or I guess 6% if you strip out the illusion of exchange rates and just look at constant currency.
Right, which is what the street really cares about.
Exactly. And on the bottom line, earnings per share came in at $1.13 as reported. But the adjusted EPS, the cleaner number, everyone is zeroing in on that, hit 99 cents.
Yeah, comfortably beating their guidance, midpoint of 96 cents.
It's a solid beat, and looking ahead to Q3, guidance puts EPS between 96 cents and $1.06.
And that's absorbing an estimated, 2 cents of unfavorable currency impact?
Yeah, 2 cents, with total revenue expected to be up 2% to 6%. And while we don't have the live ticker reaction printing on the tape for this specific release just yet, management explicitly declared revenues came in ahead of expectations.
Which is a very confident signal.
It really is. It signals a highly confident print.
It does. But, hitting a $4.9 billion top line isn't just about riding some wave of broad macroeconomic luck.
Right.
If you want to know if the global economy is actually accelerating or, heading for a stall, you don't look at tech stocks.
No, you look at the labor market.
Exactly. You look at the companies that hire temporary warehouse workers, supply chain managers, IT contractors.
The people on the ground.
Yeah. So our mission today is to figure out if ManpowerGroup's confident tone reflects a real operational turnaround, or if they are just, masking structural weakness with clever accounting.
So we really need to take this $4.9 billion apart piece by piece, because when I look at these sources, I see a global company, sure, but the performance is just wildly uneven depending on where you look on the map.
Oh, completely uneven.
Like we have massive geographical divergences here.
A global staffing firm is essentially a mirror of the global economy, right? And right now, the reflections in different regions are just completely disjointed.
Yeah, that makes sense.
So if we break down the regions, Southern Europe is the undeniable heavyweight of this entire enterprise.
It really is.
It accounts for 47% of total revenue. They pulled in $2.3 billion there, which is up 7% on a reported basis.
Wait, but why is Southern Europe so dominant for them? Like, almost half the revenue from one single region seems incredibly lopsided for a brand with global aspirations.
It really comes down to structural labor dynamics.
Okay, how so?
So in Southern Europe, particularly in countries like France and Italy, labor laws are famously rigid.
Right, the unions.
Exactly. It is very difficult and expensive for a corporation to just hire and fire permanent employees at will.
So they outsource the risk.
Precisely. Because of that friction, companies rely heavily on staffing agencies like Manpower to provide a flexible workforce.
That makes a lot of sense.
Yeah, temporary work in those countries often functions more like long-term contract work.
Yeah.
It provides this massive, steady baseline of volume for staffing firms.
Okay, so if I'm visualizing this for a retail portfolio, Southern Europe is ManpowerGroup's anchor.
Anchor is a good word for it.
Right. It's heavy, it's rooted in these strict labor environments, and it's keeping the entire ship grounded by generating the bulk of the cash.
Yeah, that's exactly what it's doing.
But when I look at the growth percentages, that anchor isn't what's moving the ship forward right now. I mean, the Americas segment represents 25% of total revenue, hitting $1.2 billion, but it was up a massive 14% as reported.
A huge jump.
Yeah, and that momentum was driven heavily by an 8% average daily revenue trend, specifically in the U.S.
And to build on your analogy, if Southern Europe is the anchor, the U.S. market is the propeller.
Oh, I like that.
Right, because the U.S. has an at-will employment culture. Companies can spin their workforce up and down incredibly fast in response to economic signal.
Right, they can react instantly.
Exactly. So when you see U.S. average daily revenue trending up 8%, it means American corporate clients are actively turning the spigot back on. They are hiring again.
Which is a great macro sign.
It is. But on the flip side of that momentum, Northern Europe and the APME region, that's Asia Pacific Middle East, they showed much more muted results.
Yeah, looking at the numbers, they're just hovering around single-digit growth or slight declines.
Right, which reflects a more stagnant industrial environment in those specific pockets of the world.
I want to look closely at the actual brands within those regions, though, because the brand breakdown in these sources is, frankly, a bit confusing to me.
It can be a little dense.
Yeah, like the flagship Manpower brand had strong organic constant currency growth of 8%. I get that. That's your core industrial and commercial staffing.
The bread and butter.
Exactly. But then you look at Experis, which came in at -2%, and Talent Solutions, which was completely flat at 0%.
Right.
But management seems to be celebrating these divisions. Year over year, they look weak. Why are we cheering for a division that is literally shrinking?
Well, because in corporate turnarounds, you have to look at the sequential velocity, not just the year-over-year static comparison.
Okay, fair point.
You are right that Experis, which is their professional staffing brand dealing heavily in IT and engineering, is down 2% compared to this time last year.
Right.
But you have to remember where they were. In Q1, Experis was down 9%.
Oh, wow. So they essentially stopped the bleeding.
Precisely. Shrinking the contraction from 9% to just 2%, and that's driven largely by returning demand in the U.S., is a massive operational victory.
I hadn't thought of it that way.
Yeah, it indicates that corporate clients in the U.S. might finally be unlocking their IT budgets again after a pretty prolonged freeze.
So the tech winter is thawing.
Essentially, yes. Companies that paused software rollouts or network upgrades, like 6 months ago, are now calling Experis to get contractors back in the building.
And what about talent solutions being completely flat?
So Talent Solutions was down 1% in Q1, and now it's stabilized at 0.
Okay.
And this division is heavily reliant on RPO, or recruitment process outsourcing.
Right. I've seen that term a lot.
That's when a company doesn't just hire a temp worker, but actually outsources their entire internal recruiting department to Manpower.
Oh, wow. That's a huge commitment.
It is. So demand holding up there suggests companies are fundamentally restructuring how they hire, seeking long-term efficiency rather than just, adding temporary warehouse workers.
Got it.
So stabilizing both Experis and Talent Solutions really sets the stage for actual organic growth in the back half of the year.
Which brings us to the unit economics.
Yeah.
Because revenue is vanity, profit is sanity. Right.
Always.
They brought in $4.9 billion in cash, but I want to know what it actually cost them to get it.
And that's where the story gets interesting.
Yeah, because when I look at the margins, I see a squeeze. Gross margin contracted by 80 basis points year over year, landing at 16.1%.
That 80 basis point contraction is significant.
It really is.
I mean, in the staffing industry, gross margin is essentially the spread between what you bill the client and what you pay the worker. If that spread is shrinking, it means one of two things. Either wage inflation is forcing Manpower to pay workers more, or corporate clients are pushing back and refusing to accept higher billing rates.
And in this economy, it's probably a bit of both.
Very likely. In this quarter, the core staffing and interim business dragged the margin down by 60 basis points, and there was another 10 basis point drag from permanent recruitment.
So they are getting squeezed at the unit level.
Big time.
Every single hour a temp worker clocks is slightly less profitable than it was a year ago.
Yes.
So how does a company beat EPS expectations when their core product is literally becoming less profitable to sell?
By aggressively managing the middle of the profit and loss statement.
The operational side.
Exactly. Management was very quick to point out that while gross margins slipped, they executed significant reductions in SG&A.
That's selling, general, and administrative expenses.
Right. This means they are squeezing operational costs out of their own corporate structure.
Like layoffs and office closures.
Yeah, they're consolidating offices, reducing internal headcount, tightening corporate travel, all of that.
Okay.
By shrinking their own overhead, they generated meaningful profitability growth that effectively offset the gross margin pressure at the top.
Okay, but I feel like we need to break down how they actually arrived at that $1.13 reported EPS.
Let's do it.
Because when I look at the EPS bridge in this earnings presentation, it feels like it's distorting the picture of the underlying business.
Let's walk through the math.
Okay, so the guidance midpoint they gave the street was 96 cents.
Right.
But the operational performance of the actual staffing business, the temp workers, the IT contractors, the RPO services, all of that only added a modest 4 cents against that guidance midpoint.
Yeah, just 4 cents.
But the massive tailwind here came from a one-off event. They sold their Jefferson Wells U.S. business for $100 million, which netted them $88 million in cash.
That's a big chunk of change.
It is. That single asset sale added 37 cents to the EPS.
Yeah.
So I have to push back here. If the core business only generated 4 cents of upside, and 37 cents came from pawning off a subsidiary, shouldn't retail investors view this beat with serious skepticism? Are they just padding the quarter with a disposition to make the headline numbers look better?
It is totally crucial to view that reported $1.13 with skepticism, which is exactly why the adjusted EPS metric exists in the first place.
Okay.
You're completely correct that the 37-cent gain from selling Jefferson Wells is a non-recurring benefit. You can't sell the same asset twice.
Exactly.
It absolutely pads the reported number.
Yeah,
However, if you are going to strip out the one-off gains, you also have to strip out the one-off penalties.
fair point. What were the penalties?
Well, during the same quarter, Manpower took a 23-cent hit from restructuring and strategic transformation program costs.
Oh, so the severance packages, the cost of breaking office leases, the internal reorganization.
Exactly. Management is taking structural costs out of the business for the long term, which cost them 23 cents this quarter.
Right.
While simultaneously selling a non-core asset that gained them 37 cents.
Ah, I see.
This is why we focus on the adjusted EPS of 99 cents. It strips out the noise of the asset sale, and it strips out the noise of the restructuring charges.
It levels the playing field.
Yeah. And when you look at that clean 99 cents, it is still a solid beat over the 96-cent midpoint.
Yeah.
It was driven by that 4 cents of operational outperformance and a slight 1-cent currency drag. So yes, the reported number is messy, but the underlying operational beat is legitimate. It's modest, but it's real.
Okay, that helps clarify the narrative. The numbers show a company leaning heavily on an American resurgence, cutting corporate fat, and strategically offloading non-core assets to fund their transition.
That's the playbook right now.
And management is not being shy about this transition either. CEO Jonas Prising made a very bold statement in the release.
He did.
He declared 2026 an important inflection point for ManpowerGroup as they execute a transformation strategy to drive long-term durable growth.
Inflection point is a heavily loaded phrase for a legacy staffing company.
It's a huge claim.
By using those exact words, management is signaling to the market that the pain of restructuring is peaking right now.
Like the worst is over.
Exactly. They are telling investors that the heavy costs of reorganization are mostly in the rearview mirror, and margin expansion is expected to follow in the upcoming quarters.
But how are they actually going to achieve that margin expansion? Because here is where the narrative gets a little murky for me.
Okay, how so?
Management specifically cited advancing their AI capabilities to improve productivity and unlock higher value solutions.
Right, the Power Suite platform.
Yeah, they named their Power Suite platform as the key to developing and deploying AI at scale. Now, let's be real for a second. We recap earnings every day.
We do.
Every single company across every sector throws AI into their press releases right now for a cheap valuation bump.
True. Buzzword bingo.
Exactly. I have to challenge this. Is this just corporate buzzword bingo, or does AI actually represent a legitimate shift in unit economics for a staffing firm?
In a lot of industries, it is just bingo. But in the staffing industry, it represents an existential operational pivot.
Really? Existential.
Absolutely. Think about what a staffing firm actually does. The primary cost is human capital specifically. The internal recruiters matching a candidate to a job.
Right.
Historically, if you needed to place 1,000 warehouse workers, you needed an army of junior recruiters manually parsing through resumes, making phone calls, and scheduling interviews.
It's just massive administrative overhead.
It is incredibly labor-intensive.
So how does the PowerSuite platform change that?
Well, if an AI platform can automate the matching algorithm, it changes everything.
Okay.
An AI can ingest a corporate client's job requirements, instantly screen 10,000 candidate profiles, verify credentials, predict which candidates have the lowest flight risk, and automatically trigger interview schedules.
That's wild.
It fundamentally alters Manpower's SG&A. I mean, they can generate that same $4.9 billion in top-line revenue, but with significantly fewer internal recruiters on their own payroll.
So it turns a manual service business into a scalable technology platform.
That's the dream.
But wait, in this very same source document, they list their ability to deploy these AI capabilities as a forward-looking risk factor. Why would they list their own tech platform as a risk?
Because the execution risk is massive.
How so?
Manpower is a legacy firm. They have decades of entrenched processes and old databases. Integrating advanced AI into legacy systems is notoriously difficult.
Oh, I see.
If the algorithm gets it wrong, or if they fail to deploy it seamlessly at scale, they will lose market share to more nimble, tech-native startup competitors who don't have the baggage of legacy infrastructure.
Startups that were built on AI from day one.
Exactly. The technology holds the promise of higher margins, but failing to implement it properly is a genuine threat to their survival.
Which brings us perfectly to the balance sheet, because upgrading an entire global enterprise with AI isn't cheap.
No, it is not.
Before any investor buys fully into this inflection point narrative and the AI cost-saving thesis, we need to stress test the cash flow. And the cash flow reality check here might catch some people off guard. Like Q2 free cash flow is actually negative $9 million.
Yeah, it was.
I mean, that is a massive improvement from the negative $207 million they posted in the same quarter a year ago, but still.
True. But you also have to look at the 6-month year-to-date free cash flow.
Right, which sits at a negative $144 million.
Which sounds terrifying if you don't know the industry.
Exactly. I think we need to clarify this dynamic for anyone listening, because seeing negative free cash flow alongside a positive EPS beat can be really jarring for someone looking at the raw numbers.
It can be very confusing.
Why is a company that just beat earnings burning through cash?
Because of the working capital demands inherent to the staffing industry.
Yeah.
The cash conversion cycle is incredibly demanding.
Let's use a plumbing analogy to picture this.
Okay, let's hear it.
Think of a staffing business as a massive system of water pipes. The cash flow pipes often have to drain completely before they can fill back up.
Right.
When Manpower places a temporary IT contractor at a tech firm, Manpower has to pay that contractor their weekly wages immediately. The cash goes out the door every Friday.
Yep, the temp gets paid first.
But Manpower might not collect the invoice from the corporate client for 30, 60, or even 90 days.
Sometimes longer.
Right. So as the business grows, as the U.S. propeller we talked about spins faster and they place more workers, they are forced to pay out more wages up front before the client cash comes in.
That perfectly illustrates the mechanism. Negative free cash flow during a growth phase isn't automatically a glaring red flag in the staffing sector.
Yo,
It's literally the cost of keeping the water flowing through the pipes.
that's a good way to put it.
The faster you grow, the more cash you burn up front to fund the payroll.
Yeah.
The critical metric is ensuring they maintain discipline on their accounts receivable.
They have to collect on time.
Yes. They cannot let corporate clients delay payment terms too long or the pipes run dry.
And looking at their capitalization structure, they have about $1.04 billion in total debt. They seem to have the liquidity to handle that plumbing, provided the macroeconomic environment doesn't suddenly seize up.
Which, as management noted in their forward-looking risks, is still a possibility.
It's always a possibility. They explicitly called out geopolitical uncertainty and trade policy developments as factors that could materially alter their outlook.
They are executing a very delicate balancing act right now.
They really are.
They are shrinking to grow, selling off assets like Jefferson Wells and cutting overhead while simultaneously trying to upgrade their technological infrastructure and manage a demanding cash conversion cycle.
It's a lot to juggle.
It is. If they hit their Q3 guidance of 96 cents to $1.06 EPS and pull off that 2% to 6% revenue growth, it will largely validate this entire inflection point thesis.
Which leaves you with one final, broader question to ponder based on everything we've just unpacked from this earnings report.
What's that?
If a legacy global giant like ManpowerGroup is officially calling 2026 an inflection point, and they're relying so heavily on deploying AI matching capabilities to trim structural costs, what does that signal about the future of the broader labor market?
That's the real question.
Were we entering an era where staffing firms aren't just deploying human capital anymore, but rather deploying AI-assisted humans?
Yeah.
Entirely rewriting what it means to be a temporary worker.
Yeah.
That shift in how human labor is bought and sold is the underlying current you really need to watch.
Absolutely.
Make sure you follow the show for daily earnings coverage to stay ahead of the markets.